Good afternoon, and welcome to the last Learn at Lunch webinar of this year. Today we will hear from JC Hobbs on tax tips to do at the end of this year and the beginning of next year. If you have questions for JC, please enter them in the chat box in the lower right corner. For additional farm management resources, visit the eFarm Management website. I will paste the address into the chat box. JC, I'll turn it over to you now.
Thanks, Brent. What we're going to hit upon today, basically as Brent described, tax management tools, of which some can work at the end of the year or before year end, and others can work after the tax year is closed. So there's a lot of tools, a lot of options, and these are especially looking at for farmers. So what we really want to talk about is basically, the first point there, never let the tax tail wag the business dog. If it doesn't make sound business sense or sound economic sense, don't do it. Tax purposes of making decisions typically will result in wrong decisions or decisions that may not be of the best interest of the overall business life cycle. Like I said, some work prior to the end of the year, some work after the year is closed. Getting into this, now a lot of the changes here we're looking at have come about through the Tax Cuts and Jobs Act, which was passed in December of last year, December 17th. And over the course of the year, a lot of changes have been made, revisions have been made, new guidance, etc. But depreciable assets, there was a lot of issues or modifications made in the rules, particularly as they apply to agriculture and other businesses, because of what the Tax Cuts and Jobs Act purpose was enhance business growth. So depreciation expensing rules, we've got new rules apply to first year additional depreciation or bonus depreciation. New rules that apply to the 179 expensing election, where we write something off in the year of purchase. And also the old MAKERS, which is the Modified Accelerated Recovery System, and that came about with the 1986 Act. So if you look at the rules that were applied in 86, we're making some changes. We're adjusting the recovery periods for new machinery and equipment. We're also changing the rate at which we can write items off. 200% declining balance now applies. The old rules were a maximum of 150%. So essentially what we're trying to do is stimulate growth through the purchase of business assets. So basically the environment of manufacturing is where we're targeting. So bonus depreciation, it was supposed to have basically disappeared this year, 2018. We brought it back, and it's going to apply to 100% for items purchased from January 1 of 2018 to December 31 of 2022. So 4 years at 100%. It drops the next 4 years from 80 down to 20. But now the rules say it applies to both new and used. So when it was originally written in the early 2000s, it only applied to new assets. Now it applies to both new and used property. And again, it sunsets or goes away after December 31st of 2026. Now this was supposed to have gone away several times over the last few years. It's been brought back at least twice. I'm thinking 3 times. So whether this disappears again, who knows? There's some discussion of making it somewhat permanent. The other area, Code Section 179, this is the expensing. Again, it writes off 100% of the purchase of a machine or any depreciable asset in the year of purchase and placed in service. Has been made permanent. Over the years, it was always supposed to decline back to originally 97 numbers. Well, now they made it permanent at $1 million, and the annual amount there, the million, is going to be indexed for inflation. So that's $1 million investment, limitation up to $2.5 million. So anytime you invest more than $2.5 million in depreciable assets, you have to reduce dollar for dollar the $1 million that's allowed. Also, they've made some changes to the SUV rules. It made it permanent, limited to 25,000. Also, it does index that for inflation. The rules basically state full-size crew cab pickups. These are half-ton Ford, Chevy that have in Dodge, having a box length of 72 inches or less. They're considered SUVs by definition, so you have to use restricted depreciation. You can't write the full amount off. The carryover rules, that essentially, anytime you invest more than $1 million, you're only allowed the million or up to net farm income. Any excess is allowed to be carried forward into the future. So, the 179 rules basically write off 100% of the asset, limitation to, again, investment, net income, or net farm income, or net business income, and the 2.5 million. So bonus in 179, what does it do? Basically, either one of these allow us to write off 100% of the assets purchased, new and used. Bonus depreciation only applies and has to be elected out of. Only applies to 3, 7, and 10-year class assets. 3, 5, 7, and 10. So what does that mean? Well, there's groups or groupings of assets, and we'll explain later what those are. But basically, if you look at how the tax law rates or ranks machinery, equipment, cattle, livestock, or other livestock, breeding hogs, etc., they apply a class life. Bonus depreciation, it can offset W-2 wages, so it can be used to offset other income. One of the things that does occur with bonus depreciation, if you take a business pickup and decide you're going to convert it to personal use, there is no recapture requirement of excess depreciation over the original maker. So it gives us some opportunities for tax planning that 179 doesn't. And we'll contrast that here next. The 179 rules, well, it states that we have to elect to use it. Bonus applies automatically. 179 has to be an election. Now, the neat part about 179, we can use it on one piece of equipment or a percentage of a piece of equipment. So we buy a combine, we can say we're going to write off the full amount, or we're going to write off just 50% of the combine, and then we use regular depreciation on the remainder. Now, the bonus rules say we can have to elect it, and we can elect it on a series of assets, but it's based on class life. So there's the difference. The 179, it cannot create a farm loss. Bonus depreciation can. Somewhat similar to bonus, 179 does allow us to offset W-2 wage income, so we have an off-farm job, we can use part of it there. But that's the only amount that's limited, while bonus can offset other income from a variety of sources. And the conversion to personal use does cause recapture for bonus or for the 179, whereas bonus we didn't. So we kind of have to pay attention to what's going on and doing some calculations, etc. But there are some neat things that we can do with both of those. Now, the rules for machinery and equipment depreciation have changed. One of the interesting things is a shorter recovery period for machinery and equipment. Now, so farm machinery, farm equipment, placed into service 2018 and beyond, it is now allowed to be depreciated over 5 years. So we've shortened the years. If this used to be 7-year property, if it's used machinery and equipment, a used combine, it's still going to be 7-year property. So a new tractor, new combine, new planter can be depreciated over 5 years and not 7. Other items in the 7-year class, grain bins, fences, cotton ginning equipment, land improvements. So the only thing that gets the faster write-off is new machinery and equipment. Other things that changed in the farm asset depreciation rules, and again, farm assets, under the 1986 Act, it was stated they could only be written off at the rate of 150% declining balance. The new Tax Cuts and Jobs Act rates are 200% declining balance if it's 3, 5, 7, and 10-year property. Basically, that's all farm assets, breeding livestock, breeding hogs, pickups, farm trucks, tractors, machinery, equipment, single-purpose ag structures, all fit in that 5 to 10-year class life range. Multi-purpose farm structures, machine sheds, drainage facilities, water wells, these are all classified as 15 and 20-year properties. And the next line shows those can only be depreciated at a rate of 150% declining balance. So, by doing so, we've increased the rate at which we're allowed depreciation write-off. Again, the thought is stimulate investment. So if you look at, and I got the title wrong here, I've taken a $100,000 tractor. It says 150. There's a $100,000 tractor, and this shows how many different depreciation rules apply if we have a new tractor purchase. If it's used, you have to take out the first and second columns. But if we have a new item, new machinery, new equipment, you can see that we've got 8 different ways of writing that off in the year that we buy it. So it gives us a lot of flexibility, a lot of tax management opportunities. If taxable income is low, we can write it off as slow as $5,000 in the first year. If we have a lot of taxable income, we can take a full amount of it off, and you can see across the board it can range from running from $20,000 below that. So the options are wide open as to how fast we want to write something off under the current law. And again, if you're looking at new, all 8. If you're looking at used, the last 6 columns. Now we're getting into some other areas of tax planning or income tax management. Another option, and this only applies to farmers. Farmers and ranchers have the ability to use income averaging. Income averaging allows the situation where you have a large amount of taxable income. And in this example, we're going to use 2018 as being the year that we have a lot of income. We can then take the excess or a portion of it and move it back to 3 prior years. And it works well when we have low income in those 3 prior years. What I've got here, if you look at 2015 and 2016 and 17, we have income holes in the 25% bracket that we can move a series of quite a bit of income from 2018 back and tax it at a lower rate. So if we have a lot of income in 2018, by doing so we can move $60,000 of that into a prior year or prior years and wipe out current high taxable income at a high tax rate and move it back to years when we have lower taxable income at a lower rate. But there's some things that you got to watch out for. It does not reduce self-employment taxes. So self-employment taxes, that's income from any trade or business, and it is at a rate of 15.3%, and it does not impact the net investment income tax. So that's if you've got a high income earner, it does not offset net investment income to allow it to be taxed at a lower rate. It only works on farm income and farm income tax management. Another tool that applies are prepaid expenses. Farmers can, by law, buy items in 2018, so we have a large amount of income in 18. We can buy items, prepay them for things that we're going to use in 2019. Some rules that have to be followed. It has to be actual payment, not just a deposit. It has to be made for a valid business purpose, not just tax avoidance. It must not materially distort income. So you can't do a lot of this and adjust the income to very low levels. Now the Farmer's Tax Guide goes into much more detail on this, but essentially what it allows us to do is take or use income in a high income year, buy things that will be used in the following year, pay for them this year, and use them next year. Again, a great tool. Another option, deferred payment contracts. Now this again works in a high income year. Basically, We want to sell a commodity, but we don't want to receive the payment until 2019. Therefore, the income is taxed in 19, but we sell the item in 2018 when the market is right and the opportunity is there to make a little larger profit. Again, there's some requirements that have to be made. It has to be a bona fide arm's length contract with a buyer. This can be an individual, it can be an elevator. The seller cannot have any right to the commodity after it is delivered. In other words, if they deliver wheat to the elevator, we make the contract to sell it. The farmer can't get that wheat back out of the elevator. It has to be sold by the contract requirements. The farmer has to avoid constructive receipt. What that means is he can't get the income in 2018. It has to be avoided. He cannot receive access to the check or the money, cannot have right to that check or money in 2018. He can only get it in 2019. Crop insurance. This is a neat tool. If you have crop insurance payments or disaster payments, those payments, if it's strictly for crop loss or disaster losses, you can report the income, elect to report the income in the year that the payment is made or the year that you would have normally sold the crop or the animals, and hence move part of that disaster payment to the following year. Now, what the rules state, it has to be basically income that we can show under normal circumstances. Crops would have been sold or animals would have been sold in a year prior to when, or year after the year that the payment was actually received. So basically, in order to do this, farmers have to use the cash method of accounting. Well, 98% of them do. They have to receive the insurance proceeds in the same year the crop was damaged. So if crop loss, and most insurance proceeds are this way, if the crop was lost in 2018, the payment has to be received in 2018. Also, we have to show under normal practices the sale would have occurred in the year after the damage. In other words, the sale of the crop that was damaged in 2018 would have occurred in 2019, or the sale of the animals would have normally been in 2019, but due to disaster, we have to sell them in 2018. So it's sales in excess of normal for livestock. It's sales that would have normally been in 2019 for crops grown in 2018. Now, those are the ways of increasing taxable income in the future. Here's some ways that we can look at taxable income and decrease it. So if we got a large amount of income in 2019, other ways of decreasing taxable income is to make needed repairs, pay accrued interest on loans. So if you've got a machinery loan that you made a payment in, say, July, now we've got accrued interest for the next 6 months, we can pay the accrued interest and deduct it. Now we can't prepay interest. Prepaying interest is not deductible. But accrued interest, that's interest is actually due, just not yet paid, can be paid and deducted. Other tools, establish a retirement plan, deduct contributions with those, traditional IRAs, self-employed IRAs, simple IRAs. Those are some that can be used if it's desired. Now, increasing taxable income in the current year, so we have a low income year, we need to do some things that possibly bring us back up, and we expect next year to be higher. Well, there's a lot of tools that allow us then to increase taxable income. One of those being selling grain and livestock in 18 that would normally have been sold in 2019. Problem here is, again, you've got to look at weights, prices. It has to be, again, a sound business decision. If you're just doing it to reduce or modify your taxable income, it may not be the best decision. Also, delay paying for supplies, feed, or other expenses in 2019. So you take delivery in 2018, you make an agreement with the supplier, elevator, etc., that you will pay it after January 1. No problem. There it's done. That works. So you take receipt of it and pay for it in the following year. Depending upon who you're dealing with, this is a great option. Also, collecting fees, rents, any accounts that are due in 2019, move those up into 2018. So if you normally receive an annual rent check in January, talk to the tenant, see if he'll move it up into paying it in 2018 so that you'll have additional income. Another tool is to delay payment for repairs or delay making repairs into 2019. Again, all of these require that we make sound economic sense of the decision. It has to be a good business decision before we jump in and get our feet wet in this. If it's not a sound economic decision, sound business decision, doing it for tax purposes will often get us in trouble. When we get into tax planning and management, it's a year-round, everyday job. You've got to look at it pretty much on a day-to-day basis. Have to have a basic understanding of the tax law. And with the new tax law, we're just now getting our feet wet with it. The Tax Cuts and Jobs Act goes into effect this year, 2018, and we're still learning about it as the years progress, and we'll probably learn more as the future years progress. When you don't know, ask questions. Ask what if, rather than saying this is what I did, now fix it. A lot of times those oops cannot be fixed. It often costs quite a bit in tax dollars, accountant fee dollars, to get some of those problems that we create modified, fixed, etc. Professional advice, my opinion, here is maybe needed. It is often needed. And you're in tax planning, always useful. The rules are you want to level taxable income over the lifetime, so the lifetime of the business, over the lifetime of the operator. By doing so, by default, you pay less in total taxes over that period of time. We end up paying a lot of taxes with issues when we allow taxable income to jump up and down year to year. If we can level it, it does help. Now there's an evaluation link, and I was told to keep this down to about 20 minutes, and I think we've done it. The evaluation link is right there on that slide. Please provide your evaluation. I thank you for your attention. Also, pretty much everything I have talked about is in the Farmer's Tax Guide. The Farmer's Tax Guide if you download it, make sure it is the December edition. Or if you've already picked one up, if you've got one and it says October, there's been some corrections made. Go to the IRS website, download the latest one. It came out in December. It has a lot of new revisions and corrections in it. So without further ado, I'll turn it back over to Brent. If you have any questions, type them in.
Thank you, JC.
Thank you.
I wanted to remind everyone that our next webinar will be on January 22nd of next year, 2019. Dr. Amy Hagerman will discuss the new farm bill that just passed. She is the Extension Farm and Food Policy Specialist here at OSU, and so she'll be doing that webinar. Thank you, everyone, for joining us today.